Hello, thanks for joining us on Money FM 89.3. In focus next is DBS, which has just announced its first quarter results for 2023, and by and large, is a pretty decent set of numbers. We're going to unpack that as well as the bank's outlook for the coming year and other industry insights from none other than the DBS Bank CEO, Piyush Gupta. Welcome to the show, Piyush.
Hey Ryan, happy to join you.
Hey, always glad to have you on. Now let's dive into the numbers. Congrats on another record quarter. So let's recap it. First quarter, DBS reported a stronger than expected 43% jump in net profit to a new high from a year earlier. How would you describe the quarter, especially coming off another record?
Well, Ryan, obviously, I'm quite pleased with the headline numbers. You said 43% growth. That's almost $2.6 billion for the quarter. Perhaps more important, return on equity at 18.6% is not only a record, it's at the high end of return on equity of most banks in the world at this point in time. We were prudent. We put away a couple of $100 million in a management overlay of general provision reserves. And if we hadn't done that, then we could have reported even stronger results. Our costs are tracking well, they're under control. The overall portfolio looks very resilient. Portfolio quality is good. And underlying business momentum is not bad. Despite everything you hear about a massive slowdown, and the slowdown is real, our own business momentum and our pipelines are relatively robust. We saw 1% growth in the loan book for the first quarter, and that's quite decent, all things considered. Our fee income was strong. Wealth management, for the first time in over a year, our fee income went up in February and March on a sequential year-on-year basis. So, yeah, overall, as I said, a decent set of numbers, so can't complain.
Yeah, so on the back of higher net interest margins, sustained business momentum, and resilient asset quality, so pretty much putting you comfortably on track to hitting that milestone $10 billion in net profit this year, Piyush.
Well, I had said that we were short at it. It's not straightforward, and there's still some uncertainties. And the uncertainties are principally around, market momentum. Some of our businesses are reliant on animal spirits. Our wealth management business, the investment banking business. So if the markets collapse, then they collapse. However, like I said, I think we were short at 10 for the year, and the first quarter has given us a good kickstart.
All right, so lots of moving parts. And I think one of them is, of course, the net interest margins. And looking at it, you've got it at 2.12% in the first quarter. That's up 66 basis points. So it is a pretty good jump. And if you look at the guidance, you're looking at 2.05, 2.1% this year. Worth noting, your earlier guidance was for the peak to be at around 2.2%. So there's a bit of a comeback expectations. And you've signaled that the peak has been reached in Q1. So what's changed in the past 3 months?
Well, first of all, Hong Kong. Normally what happens is because the Hong Kong dollar has a fixed exchange rate with the US dollar, any increases in US dollar rates generally flow through completely to the Hong Kong dollar system. This time, as things happen, though, there is a lot of liquidity in Hong Kong. And I think that partly that has to do with the fact that many of the Chinese companies moved their loans onshore because borrowing in China onshore was cheaper. Nevertheless, HIBOR has been very weak. HIBOR is actually 60 odd basis points below the US rates, which is very, very unusual. That causes a drag of somewhere between 3 and 4 basis points on our NIM. Which means that 212, if it weren't for the Hong Kong impact, would have been closer to 216 or thereabouts. So that's, I think, the most material change. The other change is also there continues to be deposit repricing pressure. As you know, around the world, customers are increasingly looking for yield. And so there is a little bit of an element of that. But the biggest difference between our earlier outlook and now is really the Hong Kong HIBOR situation.
And also what's playing out in the wider economy. You've got a bit of a slowdown, some signs of it happening with the Q1 numbers for Singapore's GDP. I think over the weekend, we saw some headlines about more signs of retrenchment creeping up, more SMEs also going bust. How does that feed into your outlook when you're looking at a dashboard? Are you seeing that play out when it comes to some of your, for example, SME loan defaults?
Well, there are two separate questions. One is what's happening in terms of business momentum. And, while there is a general slowdown, interestingly, large parts of Asia are still quite robust. China is benefiting from a delayed opening. And as a consequence, partly because of base year effects, I think China will get a 4.5% plus growth this year. Hong Kong, similarly, as the border with China is opening up, Hong Kong is beginning to start showing a better rebound. I think you'll probably get those kind of growth rates, 3.5%, 4% in Hong Kong. And frankly, some of the other bigger economies in our system, India and Indonesia, are also quite robust. And so even though Singapore has been slow in the first quarter, even Singapore, as you know, in the last couple of days, the leadership said that we probably escape a recession. And therefore, from that prism, what happens to business momentum, outlook, loan growth for this year, I think it will be slow, but not as calamitous as you might expect. From the prism of cost of credit or delinquencies, frankly, we're not seeing any stress at this point in time. And sometimes even I'm surprised because I would have imagined after 4 or 5 quarters of high interest rates, you should start seeing some stress in the SME book, as you suggested. So far, not seeing it. Delinquencies are low. And by and large, SMEs are being able to keep their heads above water. Now, whether this continues through till the end of the year is uncertain. And that's one of the reasons why we're being abundantly cautious and continuing to build up general reserves in case there is greater stress in that portfolio. On the other hand, I do think that the SME is a lot more resilient today than it was in the past, because in the last 3-4 years, they've had reason to tighten their belt, and therefore they're a lot more robust. They went through COVID. In Hong Kong, they went through the China issues, the TMT issues, and fundamentally, the weaker SMEs have been falling off along the way. So there is certainly risk in that sector, but at this point in time, it's not showing up.
All right. So some degree of resiliency in some of the sectors that you're looking at for the SME fund, at least. The other part that is also going up is ABSD. And of course, last week we saw the Singapore government rolling out yet another round of cooling measures for the properties industry. So on that front, how much impact do you see the latest ABSD hikes having on DBS?
As the government themselves said, 90% of most buying in Singapore is for first property. In our portfolio, it's about 88%. And because they didn't change ABSD on the first property, I frankly don't expect that to have a material impact. You could see over the weekend, the crowds at the new launches, Blossoms, for example, was heavily subscribed. I think on the other extreme, which is the foreign buyers, where the sticker shock was high from 30 to 60%, I think at the top end, really top end of the market, those people don't borrow, they take cash. So that doesn't have too much of an impact on our book because they weren't borrowing from us in the first place. I think there will be some impact overall. And typically we've seen when the government has tightening measures, the impact lasts for a couple of quarters before the market steadies. So my assumption, the market is beginning to recover from the September-October tight. By March, the bookings had come back to close to normal. I think you will see some slowdown from these measures in the next few months, but I'm hopeful that it won't be precipitous.
All right. Well, in conversation with Piyush Gupta, he is the DBS Bank CEO. Now, looking at some of the catalysts that we might be expecting for DBS, some tailwinds perhaps, the China reopening story is also going to help with the travel side of things, I imagine. So that's going to be a big part in generating fee income, especially for credit cards. How much more upside is there when it comes to China reopening?
I think there is upside, not just for cards. Cards, you nailed it. Our total, in our card spend, travel typically accounts for about 15%. And it had gone all the way down to single digits. It's been creeping up. It's now at 12%. The delta between 12 and 15% is likely to come from the China opening up. And travel is a good category because it generates a lot of high quality fees. So I think that will be helpful. But China opening up, coupled with the China-Hong Kong border opening up, also has consequence for other businesses in Hong Kong. For example, our bank assurance business, our low-end wealth management business, the SME FX business, all of those get impacted by the China-Hong Kong border opening up. So I expect some tailwinds to come from there as well.
Okay, and talking about some of the exciting stuff we can look forward to, ChatGPT has been making the ripples across many sectors, and about the potential of the metaverse. How do you see these technologies playing a role in banking going forward?
Well, I think Chat GPT is definitely a game changer. We've been working with artificial intelligence now for several years. And 10 years ago in 2013, we experimented with IBM Watson with the first guinea pig. What we were trying to do with Watson at that stage, we realized we were too far ahead of the curve. We wanted Watson to really read all kinds of stuff and apply it for us. 10 years on with generative AI, I think that vision has finally been realized. And therefore, the opportunity to drive productivity at scale and to create new kinds of product offering to for our customers, that is very true today. We are currently experimenting with 8 or 10 different pilots. And in the second half of the year, we will come to some decisions on what we want to really put our efforts behind. These pilots are diversified. They include using ChatGPT to do programming and coding, using ChatGPT to, I say ChatGPT, I mean generative AI, using it for doing user testing and the use case development, for actually doing our marketing material and personalizing our marketing communication to our staff, for doing internal productivity facilitation, including minutes taking and summarizing information, whole host of different things that we're experimenting with. Now, the good news is that I do think generative AI is very consequential. It can bring a lot of benefits. The bad news, of course, is that for the first time, I really think that white-collar jobs will be at risk. So far, we've been lucky in the last 5 years. We've been able to create new jobs by reskilling our staff and finding them new opportunities as technology has weighed in. But with the generative AI, I think the jury is out on whether we'll be able to create new jobs as fast as the old jobs go. On metaverse, I do think there's an opportunity as well, albeit a little bit more difficult to conceptualize. We have some experiments in the metaverse. We are with Sandbox. We've got something called the Betaverse. We're using it for our CSR activities. Frankly, I've not been able to come up with a good use case in the core business yet. But again, there is no question in my mind that this is coming. When you reflect on the notion that 3.2 billion people play virtual games and only 2.4 billion people play physical sport, it tells you that the future generations are more and more inclined to spend time in the virtual world. And if people spend time in the virtual world, then without a doubt, the product suites and the processes to support their presence in the virtual world, that has to come eventually.
Yeah, that is a lot to watch out for. And another thing that investors are watching out for is the implications of what's playing out in the banking sector in the US. And this is, of course, with the fallout from the collapse of SVB. And of course, over the weekend, questions about First Republic. Now, to some extent, we've seen some concerns being answered with the acquisition by JP Morgan. And you mentioned that DBS back in your AGM in end March benefited from inflows amounting to a few hundred millions in the aftermath of the SVB collapse. So how much is that translating to income and activity, or are we still seeing these monies stay on the sidelines?
Well, first of all, we have been beneficiaries of inflows from the flight to safety. Till 2021, in a typical year, we got about $4 or $5 billion of inflows. Last year, we got close to 5 times, 24 billion. And the first quarter has continued at that pace. We got another 6 billion. I speculate that a fair part of that comes from the flight to safety as people are getting more anxious about some of the weaker players in the financial system. So that's obviously helpful. When money comes into us, we benefit immediately from larger liabilities that we can, in the worst case, earn a reasonable spread on, even by putting them into completely safe assets. In the longer term, it obviously improves our ability to monetize these monies by switching them from deposits into investments. In the first quarter this year, we were actually quite successful. Many of our customers are beginning to get active in the markets again. And so some of these deposits did move out to the investing category. And finally, how much money gets put to work in the financial markets and investments is often a function of animal spirits, of people confidence. So if there's animal spirits and people confidence, people will put the money to work. As you saw, our first quarter fee income for wealth management went up very nicely. And for the first time in a year, in fact, it was up year on year in February and March. So I'm quite optimistic that the new flows of money we've got, we will be able to put them to work on behalf of our clients in the course of the next several months.
And finally, Piyush, just to wrap things up on a personal note, there's this book that's been making the rounds, creating quite some buzz. It's called Lessons for My Younger Self. And it features a chapter on you, your own reflections. So looking back, you used to talk about how you're really into nature, especially bird watching, and of course, many other lessons as well. Walk us through what really some of the lessons you think people, investors, especially young ones, can learn from your past experience.
Well, I've often said, Brian, that when people ask me what would you tell your younger self, I always say I wouldn't actually say very much because I'm quite happy with the way life turned out. And, I made mistakes along the way, but I would not be the person I am today if I hadn't made those mistakes. So would I choose not to make those mistakes and turn up being a completely different person? I don't know. I think I'm relatively comfortable under my skin. But what I do reflect on in that book is this whole idea of continuing to stay grounded. It's very easy to lose your sense of self. And you have to have the confidence to recognize yourself for what you are and stay grounded to that. I think it's a really important thing to do. In fact, I did a commencement speech at NUS a few years ago, and the whole speech was really based on the simple thing, but how do you stay grounded? And one piece of advice I've often given people is stay in touch with your old friends, the ones who are your friends in school and in uni, because they know you for what you are. And, if you've got any airs and graces, it takes them 60 seconds to bring you back down to earth. So, but related to stay grounded is my other thing that, one of my regrets is in my 20s and 30s, I let many of my interests like bird watching, nature, etc., slip away. I do think in reflection that when I came back and I quit banking for a year when I was 40, when I came back with a different attitude. And I picked up some of these earlier interests of mine. And frankly, my life has been a lot more rewarding. And so related to staying grounded, my other reflection is don't forget what your younger self was interested in. And don't give up your interests. I had a lot of comments on LinkedIn. Some people said, oh, if you hadn't really killed yourself and worked in your 20s and 30s, maybe you wouldn't have been that successful. I don't think that's the case. I still work very hard. I think there's no substitute for hard work. But I don't think working hard necessarily means having to compromise on interests that you might have. And as you get older, you realize that you do need those interests to keep yourself anchored. It's also part of the grounding process. So I think that's a couple of the reflections that I had in that book.
All right, as a good reminder, don't forget to smell the roses and don't lose track of who you are and what matters to you. Well, I've been chatting with Piyush Gupta. He is the CEO of DBS Bank. Piyush, thank you so much for your time.
Well, I'm happy to do this. You take care. Have a great day. Money FM 89.